Stock. A stock is just a piece of ownership in a company. If you buy Apple stock, you literally own a slice of Apple. If the company grows and earns more money, your slice becomes more valuable. If it struggles, your slice shrinks. Share. A share is one single unit of stock. Think of stock as pizza. Shares are the individual slices. Apple has billions of slices floating around. If you buy one, you're in the club. Shareholder. When you own a share of any company, you are a shareholder. Ticker symbol. This is the short code used to identify a company in the market. Apple is AAPL, Tesla is TSLA, Microsoft is MSFT, like nicknames for stocks. Stock exchange. This is where stocks are traded. The two big ones in the US are the New York Stock Exchange and NASDAQ. It's a giant marketplace where buyers and sellers meet. Public company. A public company is one that sells shares to everyday investors through the stock market. Think Apple, Tesla, or Coca-Cola. These companies had to go through an IPO, initial public offering, to list their stock on an exchange. Market cap. It's the total value of a company's stock in the market. Formula: stock price X number of shares. Apple has a market cap of over $3 trillion. That number shows how massive it is compared to smaller companies. Blue chip stock. These are big, stable, well-established companies that have been around forever. For example, Coca-Cola, Johnson & Johnson, or Microsoft. They're the reliable players. Dividend. Some companies share part of their profits with shareholders. That payment is called a dividend. For example, if you own Coca-Cola stock, you get paid a little money every quarter just for holding the shares. Bull market. A period when prices are rising and investors are optimistic. Like the 2010s, when the stock market seemed unstoppable, that's a bull run. Bulls thrust upward with their horns. That's why it means up. Bear market. The opposite of a bull market. Prices are falling, fear takes over, and people sell. A bear swipes downward with its paw. Down equals losses. Volatility. Volatility is how much a stock's price moves up and down. A calm stock barely changes day to day, while a volatile one swings wildly. Think of it like waves. Steady ripples versus big, unpredictable tides that can reward or sink investors. Volume. Volume tells you how many shares are bought and sold during the day. High volume means lots of activity, which can signal excitement or panic. Low volume means fewer trades, so prices may move more slowly or feel less liquid. Portfolio. Your portfolio is basically your basket of investments. It could include stocks, bonds, real estate, crypto, or even gold. Together, they show your overall financial picture, not just one single bet on a company. Diversification. Diversification is spreading your money across different types of investments so you don't put all your eggs in one basket. If one stock or sector crashes, others may rise or stay stable, protecting your wealth overall. Index. An index is like a scoreboard for the stock market. It tracks a group of companies to show how the market's performing overall. The S&P 500 is a snapshot of 500 major US companies' combined performance. Index fund. An index fund is a simple way to invest in the whole market at once. Instead of guessing which company wins, you buy a slice of an entire index, instantly owning hundreds of companies with one purchase. Exchange-traded fund. An ETF is like a flexible cousin of index funds. It bundles a group of assets, stocks, bonds, commodities, and trades, like a single stock. You can buy or sell it anytime the market's open, making it super convenient. Mutual fund. A mutual fund pools investors' money together so professional managers can pick stocks or bonds. The goal is to beat the market, but management fees are higher. Some do well, but many don't consistently outperform cheaper index funds. A hedge fund. Think of a hedge fund like an exclusive investment club. Only very wealthy people or institutions can join, and they pool their money together for a manager to invest. But unlike a normal mutual fund that sticks to safer investments like stocks and bonds, hedge funds can do almost anything: short selling, betting on currencies, trading derivatives, or even buying farmland. The idea is to hedge against risks and try to make money no matter what the market is doing. IPO, initial public offering. When a company first sells its stock to the public, think of it as the company going from private to public. Facebook's IPO in 2012 is a famous example. Market order. an instruction to buy or sell a stock immediately at the best available price. Fast and simple, but you don't control the exact price you'll get. Limit order. This lets you set the price. For example, buy Apple if it drops to $150. Your order only executes if the price hits that level. More control, but less guarantee. Bid and ask. The bid is the highest price someone is willing to pay. The ask is the lowest price someone is willing to sell. The gap between them is called the spread, liquidity. How easy it is to buy or sell a stock without moving the price too much. Apple stock is very liquid because millions trade it daily. Broker. A broker is basically the middleman between you and the stock market. You can't walk into the New York Stock Exchange and buy a stock yourself. A broker handles that for you. Interest. Interest is the cost of borrowing money. If you take out a loan, the bank charges you interest as its profit for lending. But if you put money in a savings account, you earn interest because now the bank is borrowing from you. Bond. A bond is basically an IOU. Governments and companies issue bonds when they need money. You, the investor, lend them that money, and in return, they promise to pay you back with interest. Commodity. A commodity is a basic good that can be bought or sold in bulk, like gold, oil, wheat, or coffee. Unlike stocks, which represent ownership in a company, commodities are physical things that the world needs. Return on investment, ROI. ROI is how you measure if an investment was worth it. The formula is simple. Profit divided by cost times 100. If you invested $1,000 in a stock and later sold it for $1,200, your profit is $200. Divide that by your original $1,000 and multiply by 100, and you've got a 20% ROI, dollar cost averaging. Instead of trying to guess the perfect day to buy, you invest the same amount of money at regular intervals, say $500 every month, no matter if prices are high or low. Over time, this smooths out the ups and downs because you buy more shares when prices are cheap and fewer when prices are expensive. Correction. A market drop of 10% or more from recent highs. It sounds scary, but corrections are considered normal and even healthy in long-term investing. Without them, prices could climb endlessly until they become completely unrealistic. Recession. A recession is when the overall economy slows down badly. The textbook definition is 2 straight quarters of negative GDP growth. In simpler terms, businesses sell less, people spend less, unemployment rises, and confidence drops. Stock markets almost always take a hit during recessions because companies earn less and investors panic. Bubble. When prices rise far beyond real value due to hype. The dot-com bubble of the 1990s is a textbook example. Eventually, bubbles pop. Crash. A sudden steep market drop. 1929, 1987, 2008. Crashes are fast and brutal. Recovery. The bounce back after a crash or recession. Over time, markets historically always recover, though it can take years. Compounding. Reinvesting your earnings so they generate more earnings. Albert Einstein supposedly called it the 8th wonder of the world. The longer you stay invested, the more powerful it gets. Yield curve. A chart showing interest rates on bonds of different lengths. When it inverts, it often signals that a recession is coming. And that's it, every important stock market term. Like the video and let us know in the comments section below, what do you want to see next? Thanks for watching.